Hello and good afternoon. My name is Sing Yao. I'm standing in for Thilan Wickramasinghe today as he's away at the DBS analyst brief. So first on context setting, global stock markets last week was generally soft. Negative sentiment on software stocks intensified after Anthropic announced new AI features that basically simplifies financial workflows on its Claude chatbot. Then on top of this news, OpenAI also launched its version called OpenAI Frontier, which basically also allow corporates to use AI agents to perform similar tasks. Now, these tools added to much anxiety that AI will upend the business models of traditional software companies, and we saw Microsoft shedding almost 9% intra-week at its lowest point. The big question here is when will the Chinese announce new innovation that can beat the Americans and whether it will come at a cheaper price point. So we take a step back and assess. This may be another deep seek moment because if we look at the price action of tech stocks last Friday, the sell-off may be overdone and we saw some rebound, especially in Microsoft. So despite the volatility in AI themes, perhaps the smarter way to play the tech theme is really to consider the infrastructure stocks. For example, Singtel. And today we'll be speaking to our analysts who will walk us through in terms of why some of these plays might be interesting. And last but not least, we also took the opportunity to record a pre-segment with Thilan on his thoughts about DBS. But first, without further ado, let's go to Hussaini, our telco analyst on Singtel. Hussaini, welcome to the show. Let's first talk about Singtel. Now, as we know, KKR and Singtel announced a deal to buy stakes in data center operator ST Teledata Global Data Centers for 6.6 billion last week. Does the acquisition align with Singtel's DC ambitions, and how much will EBITDA contribution from DC-related growth engines change over the horizon? Hussein?
Yeah, sure. Thanks, Sangyo. Can you hear me?
Yes.
Okay, yeah, thanks. So yeah, yes, Singtel did make a big move into the data center space last week with the partial acquisition of STT. And Singtel has made it very clear that data center and the related fields, and I will go through it in a bit, remains one of their key growth pillars. So the main business remains telecom, but that remains the growth pillar. Uh, so company has noted that currently around 14 to 15% of their EBITDA comes from those growth engines, and data center is one of them, and the ambition is to take it to 35%. So 14 to 15 going to 35%. So we can understand the kind of investments and opportunities they see in the data center and those growth pillars. Now, important thing is that Singtel doesn't just play into the data center area. That's one key growth area, but Singtel has other levers as well. So above data center is the connectivity business because data center needs to be hyper connected, and Singtel has all the connectivity infrastructure in Singapore and across the region, whether it is submarine infrastructure, whether it is fiber, terrestrial fiber, and things like that. And that plays a critical role, and that remains an opportunity in the data center space as data center grows. Then the other layer is the next layer is data center itself, and Singtel is very active in that space. Based on our estimates, the data center growth in Asia to be in the range of around 15 to 20% over the long term, and Singtel is going to play a critical role. And below data center is you can call it AI or cloud or AI application kind of services, and that is also area where Singtel is playing a role. And what management is saying is that over the next few weeks or months, we expect to hear more good news into those initiatives, which is AI or AI as a service, GPU as a service kind of infrastructure or announcement. So net company is playing a big role into that space. Ambition is to take the EBITDA contribution from 14-15% from those growth engines to around 35%. And this STT acquisition is a step in that direction.
Okay, that's great to hear. So multiple angles to play this name. My next question is this: Do you reckon that the Optus issue is now in the rearview mirror? And we saw a spike in Singtel share price on the STT GDC deal.
Mhm.
Do you see more upside from here? How do you expect the stock to trade in the short term?
See, we remain buy on Singtel, and our target price on Singtel is $5.08, and we see further upside. Now, I would say that Singtel is can be easily understood that it has eight businesses, four are its core businesses, and four are associates. And in the core businesses, we remain quite hopeful, obviously, on the data center and cloud and AI initiatives. At the same time, on the Singapore side, we are hopeful that on the back of consolidation, things are expected to improve. Singapore mobile business or the consumer business was quite a bit of pain for Singtel, and we expect it to improve going forward. Then they have NCS and Optus. NCS is expected to do okay, and Optus, no doubt, had been a bit of a pain because of the outage last year on the emergency call services. But otherwise, Optus is also doing okay operationally. They are on track to cut costs, and in general, the Australian market remains quite healthy in terms of competition. So, Optus side, there are some pains related to network outage, not network outage, but the emergency call outage. But otherwise, Optus remains a good business. Now, as far as associate goes, and the associates are the one which contributes around 70% of the company's earnings. Within that associate, the largest is Bharti Airtel in India, and that company is doing fantastically well. It has been doing well for the last many years, and obviously, India is a two and a half player market, which kind of helps in terms of competitive rationality. Then Indonesia and Thailand. Thailand, their associate AIS just announced a big special dividend, which will contribute around $500 billion as special dividends for Singtel alone. So that part of the business is doing okay. Indonesia, we see price improvement. So all in all, within their eight businesses, almost all the businesses are doing okay. Optus, there were some pains, but Optus means operationally, Optus is also okay. So we see quite a bit of catalyst and opportunities with Singtel.
Okay. Can you remind us again what's your fair value price on Singtel?
It's $5.08, and it is an SOTP driven my target price. And in that target price, I uh, take around 20% cut because of the holding company discount.
Okay, great. Thanks very much for those comments, Husseini. We believe that that's on your conviction that there's still a lot more upside on Singtel. Thank you. With this, let me just bring in Krishna, our REITs analyst, into the call. Now, Krishna has also written up an interesting note on Keppel DC REIT not too long ago, and we wanted to basically check back with him with this thematic on AI, data centers, what his thoughts are basically on Keppel DC REIT. Krishna, welcome to the show. I'd like to first ask you, with Singapore's DC supply expected to stay very, very tight over the short, medium to long term, what does the latest set of results say about rental momentum for Keppel DC REIT? Krishna?
Yeah, and thank you, Sangyao. Thank you for having me on the show. So you are right. I think what we are seeing is for the Singapore portion, when the legacy leases are coming up due for renewal, we are seeing the mark to market of those leases. And then we are seeing quite substantial positive rental reversion. So to share some stats, for last year, we saw the reversion at the portfolio level about 39%. For 2025, we have seen about 45%. So those rental reversions will continue. Management has guided for positive reversion, but the timing of that will be very much dependent upon when those legacy leases come up for renewal.
Okay, all right. Can you walk us through Keppel DC REIT's acquisition strategy? And perhaps a more focused question is geographically, has the deal pipeline remained more or less the same, which was, I think, for the longest time targeted at Europe, North Asia, and Singapore, or has this changed?
So the focus right now, and again, I'm shifting a bit from the geography to the underlying assets. The focus is tilting to move towards the hyperscalers. So they do have a mix of both co-location and hyperscalers, but they want to shift the mix a bit more towards hyperscalers through acquisitions. Since IPO, they have added Japan as well in their geographic footprint. So the focus will be on the existing geographies which you mentioned about Singapore, Europe, and then in the remaining Asia Pacific, these includes Australia, Malaysia, China, and Japan. But I just want to remind investors that they do have a global mandate as well. So I think that is something which we need to keep in the back of mind. But I think the immediate focus right now is for them to also grow their top line organically, which is an interesting strategy wherein they will take back some of the underutilized contracted power and then release it to somebody else at a higher rate. So they're basically taking a bit more of a granular approach, not just the headline occupancy, but also the utilized power levels rather than just the contracted power levels. So that's primary will be their sort of organic and inorganic growth angle that they have.
Okay. Well, Krishna, talking about Keppel DC REIT's various projects around the world, can you also comment about its assets in China, specifically the Guangdong data center assets? What's happened to those assets, and are they going to be restructured or kept in the portfolio? What impact do we see on the DPU outlook of Keppel DC REIT?
Yeah, so I think glad you brought this point. So I will characterize it. It's a work in progress. It's a bit unfortunate, but I think they have been taking some of the they're recognizing the revenue, but as well as doing the impairments in for those recognized revenue. Right now, I think they're still working with the operators in terms of arriving at a resolution, but it is definitely taking a longer time. And I think what management alluded to is that there were some headlines about some of the top internet names getting hold of some of the chips. So clearly, I think if there is some breakthrough in terms of the DC operators getting hold of the relevant chips, either through imports or through domestic sources, that will be a positive catalyst. So any trade relaxation or domestic breakthroughs will be helpful. But as of now, it is still very much a work in progress.
Okay, then can you just remind us what your fair value and target price is for this stock?
So we have a fair value of $2.60, and this is based on our dividend discount model that we use for all the REITs.
Okay, great. Thank you. Krishna, let me just keep you there for just one more comment on another REIT. Capital Land Ascendas REIT results, they released results last week. So on a full year basis, DPU fell marginally compared to 2024. What was your read overall about this REIT's performance?
So I think, as you rightly said, I think the decrease in DPU is a bit underwhelming because they have done string of accretive acquisitions over the last 5 years. But I think it is explicable because I think the whole business space portfolio that they are known for is going through some churn, and this is not something which is in Capital and Ascender's hand. I mean, the market forces are driving that. So they are trying to reposition the portfolio through redevelopments, as well as they are recycling as well some of the older assets and then repositioning the mix to a bit more of high specifications, well amenitized business parks as well as data centers. So that's, I think, is the overall read for the result. So it's a portfolio that is being kind of reconstituted, and investors have to be patient and unfortunately have these phases of whereby the DPU kind of has declined.
I see. So this decline is probably temporary in your view, and that looking at capital and Ascender's REITs reinvestments going forward, there's probably light at the end of the tunnel. Yeah.
Yep. I think I will say that once the development projects come on board and they are able to backfill the space, I think the accretion, etc., which will come through, which is right now not visible because once you divest or reposition, then there is a income vacuum that's created there. So I think investors have to be a bit patient, but hopefully, as you mentioned, there is light at the end of the tunnel.
Okay. Thanks, Krishna. Thanks very much.
Thank you for having me.
Yes. So now we'll go to DBS. Now, DBS FY25 core earnings seem to be below MIBG's and the street expectations. We now go to a pre-recorded segment with Thilen, which we did earlier this morning, to talk about the core reasons and if this has changed his view about DBS's ROE delivery outlook and the dividend pathway. May I turn this over to the administration team for the video, please?
Yeah, okay, Sanya. Let me just give a quick rundown of DBS's results that came out this morning. Core earnings were actually below expectations. It came in about 95 to 97% of full year estimates of the street, so a little bit disappointing. Fourth quarter core earnings fell about 10% year on year and 20% on a quarter-on-quarter basis. Large part of that was actually weak trading income as well as some higher specific provisions. So the overall treasury income was down about 20% quarter-on-quarter. Typically, the run rate there is about 400 million or so for the last 3 quarters. It came in at about 154 million for fourth quarter, so a big drop there. So that's something that we're watching out for. And but management is saying that the run rate going into January is quite strong. Net interest income also underwhelmed, down about 2%, but was kind of flat to slight growth on a quarter-on-quarter basis. NIMs are down about 3 basis points quarter-on-quarter, which to us says that things are starting to stabilize on the margin side. And deposits were actually up quite strongly, about 12% year-on-year. And that's actually helping DBS take some of that cheap liquidity and invest it into high-quality liquid assets, which actually helps them keep their spreads up and keep NII or net interest income supported. Loan growth was in line about 3%. We did see large corporate loans coming through. We also saw manufacturing coming through, but surprised us a little bit that construction and building as well as mortgages were actually negative. Maybe some of that construction loans are in that large corporate segment. Something that we are watching out for with OCBC and with UOB as well, because they're a lot more heavily geared towards construction. Fee income was better than expected, largely coming from wealth management. But one of the things that we were surprised about was specific provisions that actually spiked up, partly from an NPL that came from reclassification of a property asset. So something like what we saw with the other banks as well, commercial real estate continuing to come back to bite these banks is something that we're watching out for. But DBS does have a lot of general provisions, and even in this quarter, they actually reversed some of those general provisions. So the overall impact on the P&L was actually fairly flat. Dividends came in line, about 36 cents, and we have very clear visibility till 2027. So overall, a fair set of results. We think growth is flattening out as we go into 2026, but dividends will continue to increase for DBS. So for investors looking for yield, the DBS will still offer that yield upside. Also, we are a lot more positive amongst the banks with OCBC going into their fourth quarter results. I think they have a lot more levers to pull: new CEO, construction loans, SMEs. So all of that should provide them, and capital returns as well, should provide them with some upside levers. UOB going into results were a little bit cautious given asset quality issues, and also looking at DBS's contraction on wealth management, we think UOB also might see some of that as well. So something to watch out for. So yeah.
Okay, thanks, Dylan. Thanks for that view on DBS as well as a preview in terms of OCBC and UOB's upcoming results. Now we've come to the end of the program, and as always, we appreciate your business and time that you spent with us over this lunch hour. If you wish to obtain a copy of the reports that we spoke about today, you can either retrieve them from the Maybank Trade app under the Market Insights page, or contact your sales representative. They'll be more than happy to basically pull this report for you. Last but not least, we'd like to take this opportunity to wish everybody a merry and blessed Chinese New Year. The show will basically resume 2 weeks from now, so please be reminded that next Monday there will be no Market Mondays. So again, thank you very much again, and we look forward to seeing you again. Thank you.